Are investors getting impatient, Mohammed? Is it justified?
Yes, they're getting impatient. Yes, it's justified because markets are in the business of reflecting what's going to happen. So we've had a significant move after the election on announcements, on pro-growth policy announcements, and markets are now waiting for detailed design and policy implementation.
Yeah, and how much of a gap, Mohammed, before investors get nervous? How much of a gap between the policy announcements and the implementation on Capitol Hill?
So a lot will depend on what we see over the next few weeks. My sense is we will get more details on the policies. But remember why this is needed. You just pointed out the Chinese export numbers that suggest that the global economy is weak. So there are headwinds for the US economy from the global economy. Second, there are long-standing structural headwinds. Third, valuations are quite high. So that's why you need continuous fuel into the stock market in order for stocks to go higher. In the meantime, rotations and relative value is where the money is going to be made.
Mohammed, markets don't tend to like uncertainty, and yet they're liking this environment. What are they so certain of?
So they like the fact that they've heard about deregulation, that they've heard about tax reform, that they've heard about infrastructure spending, and they've heard about the possibility of money coming back into the US because of repatriation. The uncertain element comes from the trade side. And so far, the rhetoric on the trade side has not been as sharp as it was during the campaign. So that's why markets in general have put aside the uncertainty of the trade side and have embraced the pro-growth elements.
Yes, but it's a different kind of rally, right, Mohammed? I mean, it's being called the Trump rally, and definitely other elements are playing into the, the good feeling out there right now. But for example, last year, the year before, when the Federal Reserve was reassuring everybody that it was going to take care of what it could, markets didn't rally to this extent. Why are markets so convinced that these policies will A, be implemented, and B, end up being good for the economy?
So convinced is a strong word, but they're hoping. And they're doing so, Vani, for two reasons. One, unlike the Federal Reserve, the measures that have been announced, not detailed, but announced, actually address some of the long-standing weaknesses of the US economy. What's been holding back growth at 2% as opposed to 3% or plus. And the second reason, and it's an important one, these are not new announcements. You know, a lot of them featured in the Obama administration, but they got nowhere. Why? Because Congress was in no mood to enact economic reforms. That is also changing. What the market is seeing is a Congress where both houses have Republican majority. So they see a repeat of the policies plus a bit more, and they see greater probability of passage.
Mohammed, we mentioned the Chinese trade data. It's been a year dominated by the Chinese once again, meddling in markets. We've got interbank rates rising. Similarities to the beginning of last year. How do you expect the exchange rate to pan out in 2017? To what extent are the Chinese going to allow the yuan to decline further this year?
You know, it's interesting, Mark, because I've learned two things over the last few months from just watching the exchange rate in China. The first is that Chinese officials learn very quickly. So a year ago, it was the offshore market that was leading the onshore market. This time around, the onshore market has acted as more of an anchor. The second thing is the Chinese realized that you could have excessive depreciation, and that's what they've realized over the last few days and weeks. Why? Because the more you depreciate, the more you encourage capital outflows. So what we're seeing is a tweaking in their policy stand, less managed depreciation and more controls on capital outflows. The key thing is, can they get the overall economic balance correct? And that's what we're going to see over the next few weeks. But it's amazing to me the extent to which the Chinese tend to learn about how to conduct their policies as opposed to repeat mistakes.
Mohammed, I've got to ask you about the pound because for those currency geeks, of which I know you're in that category, 121.23, of course, was the October low. We came through it on an intraday basis, but we haven't managed to close through it. Massive week next week, Mohammed, with Theresa May outlining her Brexit vision. What's your forecast for sterling? Because right now, Mohammed, as we know, this is trading as a purely political currency. This isn't trading on the macro fundamentals. This is trading on fear of hard Brexit. What's May going to deliver next week, and how's the pound going to react?
So it should be trading on politics, because the decision between soft Brexit or hard Brexit is a political one these days. And it's a big deal. You're talking about the trading relations of the United Kingdom with its main trading partner. So this has massive impact on the foreign exchange market. You know, it's interesting because the foreign exchange market got comfortable with the notion not of soft versus hard, but of slow Brexit, that it was going to take time, that we don't need to worry about it. And then suddenly, over the last few days, and with the announcement of the speech you just mentioned next Tuesday, suddenly there's a realization we may go back to getting a lot more evidence between hard and soft Brexit. That's why, as you pointed out at the top of the program, that's why sterling volatility is higher. And I don't know what we're going to get on Tuesday. My hope is that we're going to get indications of a soft Brexit. My fear is that we're going to get indications of a hard Brexit. But I really don't know what Theresa May is going to say.
Mohammed, speaking of trade negotiations and redoing them, let's move back to China for a moment. What if there's a cooling of the relationship between the US and China? What does that mean? Even if it's a geopolitical cooling, does that impact financial markets and trade between the two?
It's one of the major risks for 2017, that you get disruption to trade relations, not just with China, but also with Mexico. And these are the two countries that are most often cited by the president-elect. And I don't think markets will be comfortable about this. So far, as I said earlier, so far the rhetoric has softened. And that's why markets have embraced the pro-growth element and set aside the trade protectionism. But if in your scenario we get more trading, more tensions on the trade side, then that certainly wouldn't be comforting for markets.
And speaking of markets and currency markets, let's take a quick look into the Bloomberg and the ADXY index, the index which does not include the yen. You can see how much it's weakened just over the last few years. Even last year, in January, when we had the tantrum in emerging market currencies, you didn't see this drop as much. Is there the potential for an EM currency crisis, or at least turmoil?
What we've seen in Turkey, what we've seen in Mexico, what we've seen in China is at a certain point, a depreciation goes from being a good thing. Why is it good? Because it enhances competitiveness, to being disruptive. It can be disruptive on the inflation side. That's what Mexico is discovering, having to hike up administered prices. It can be disruptive on the capital outflow side. That's what Turkey and China are discovering. So yes, it can be. What I look at most closely is the extent of currency mismatch among the corporate sector. This notion that there's always an inclination to borrow in dollars, even though you're generating most of your revenue in local currency. And you get a mismatch in your asset liability, in your income statement, and next thing you know, you've got a problem. So that's what we should look closely. But it's not a surprise to me, Vonnie, that the Bank of Mexico, that the central bank in Turkey, that in China, all of them have stepped in to try and reverse what they view as an excessive depreciation.
Mohammed, really quickly, final question. Give us an idea of a trade that you're making, you're thinking of making, or we should make at the start of 2017. What's top of the pile, given all the themes we've discussed?
So if you've got an appetite for lots of volatility and you're able to maintain your position, then foreign exchange in emerging markets is attractive. They have overshot in many cases. They will, I think, over time come back, but it's going to be an incredibly volatile issue. So you have to put it in that part of your portfolio that can tolerate significant volatility.